Good afternoon to all of our NACD members and guests and my fellow panelists. My name is Steve Osborn. I lead the San Francisco office of Mintz. Mintz is a full-service law firm with 600 attorneys across the US and Canada, and we're especially known for our work with public and private companies and investors in the life sciences and technology sectors, and for partnering with private equity firms and their portfolio companies on everything from fund formation to M&A deals. As for me, I work mostly with growth stage companies to help them grow, get funded, and eventually exit. I hope in that order. And we've got a terrific panel for you today. And before I invite the panelists to introduce themselves, I just want to kick off with a little bit of context. So I'm going to paint a familiar scene. You're at dinner with a colleague, and they casually mention to you, "Oh, I just joined the board of this private equity-backed company." And you are nodding politely, but deep down you're wondering if you should send some flowers or a sympathy card. And that reaction isn't totally uncommon. Private equity boards do have a bit of a reputation, and sometimes earned, sometimes not. And today we're going to explore whether that reputation is deserved. And given that we're here and on this topic, you're going to find out that we feel it's not deserved. But let's dive into the real world here today and get some great stories from our panelists. We're going to talk a little bit about the good and the challenging and the misunderstood parts of these PE-backed boards. And we're going to delve into what's expected of directors and how our panelists have not only survived, but really thrived in the private equity board market. We'll talk a little bit about crisis planning because, well, 2025 and crises are still a big thing. And we'll keep things a little optimistic because we'll close our conversation with how directors can uncover value and opportunity, even in a complex market like today. We want this to be interactive, so don't be shy and drop your questions into the chat at any time. And with that, let's meet our panelists. I'll hand it over to each of you for a quick introduction. Let's start with Bethany Mayer.
Hi there, my name is Bethany Mayer. I think I know several of you, so good to see you. I'm a member of NACD. I also serve on 4 public boards, Box, which I chair, HPE, Lam Research, and Astera Labs. And in addition, I serve on private boards, one of which is a private equity board with Vista called Securonix. I also am a former executive partner with Cirrus and did a number of both deals as well as I served on several boards for them. And then prior to my board service, I was several years in the technology industry, ending my career as the president and CEO of Ixia, which I sold to Keysight. So that's all for me.
That's it, Bethany? Nothing else? What a wonderful background, and thank you for coming and sharing your thoughts. Mike, will you go next?
Sure. Thanks for joining us today. My name is Mike Sabbatis. I'm the chair of Caseware International. Caseware is an audit software company and technology company. We've got 20,000 customers, are in 130 countries and 20 different languages. I also serve on the Americas board of Iris Software Group. Iris is an accounting software company, among other things. Both of these are private equity backed companies. This would be my 7th board that I've been with since 2012. Prior to that, I was the CEO of XCM Solutions. It was a workflow software company that I exited from in 2020. And I was the CEO of Wolters Kluwer North America, publicly held company. And I held C-level roles at RealPage and also at Thomson. And I've been in the technology industry since I graduated from college, so for about 40 years now. Thanks.
Okay, Mike. Well, you admitted it. 40 years. We didn't have to get it out of you. All right, Mallory, you're next.
Hi, I'm Mallory Brown. I'm a vice president with TPG Global. I've been with TPG about 6 years, and I oversee people and talent analytics in the operations group. So our team is portfolio facing, and I keep track of all of the board directors and C-suites across our entire portfolio of companies, which is around 350 companies. And then I also execute all the board searches on behalf of the portfolio companies that come into our ecosystem. Prior to TPG, I was at Aegon Zender for 13 years. 10 years on the client side, specializing in healthcare and life sciences, and 3 years overseeing the firm's digital transformation.
So basically that means that of all the people on this panel, you're the person to know if you want to serve on a private equity board, because you have the most access and knowledge probably about that. And then of course, when the crises hit, we'll call everybody else on the panel.
Probably the best, yes.
And speaking of somebody who deals only with crises, it seems like it's my partner, Alex Kaufman. Alex, why don't you go next?
Hey, thanks a lot, Steve. And not one, two, but three very tough acts to follow. If I have half as much success in private equity as my three esteemed co-panelists, I'll be a very lucky man. So thanks for that, Steve. As Steve mentioned, I'm a private equity M&A partner at Mintz. I split my time between our San Francisco and San Diego offices. I focus and deal almost exclusively in the middle market, predominantly in software and technology sectors, although I also have experience working with investors and operators in manufacturing, consumer goods, digital health, and healthcare IT. I predominantly represent institutional investors, and that ranges from hedge funds to growth equity funds, private equity funds, and private credit investors on a range of complex and strategic transactions, predominantly leveraged buyout transactions, growth equity, complex secondaries, VC investments, distressed M&A, and private equity co-investments. I also do a lot of cross-border work, predominantly involving Europe, Korea, and Israel. And I also represent founders, CEOs, special committees, and other actors in the private equity and deal-making ecosystem on a variety of corporate fiduciary matters, and obviously a lot of fund transactions and crises, as Steve mentioned. And I look forward to meeting many of you and further discussing private equity boards and their public counterparts. Thanks, Steve.
That's great. Thank you. Thank you all. So our first topic today is really around the unique aspects of how PE boards are constructed, and then how our panelists have found ways to add value in that ecosystem. And so I'm going to start actually with Mallory here and talk a little bit about how TPG looks at filling out a board of a company they've acquired, and how that plays out in your world.
Sure. Thanks, Steve.
Yeah.
So I think the typical private equity investment, when a company takes the majority or 100% ownership, that board is often comprised of members of the deal team who were working on that particular investment, as well as the CEO or perhaps the founder of the company that's being acquired. And in addition to that, we often look for additional people who are coming from the direct industry or sector from that company and have experience leading operations, doing strategy, and we really feel we can back to help us achieve the value that we see by investing in that company. So we cast that net pretty large. And we typically partner with a lot of different organizations, as well as digging deep into our network of people and ask for recommendations and ideas for who could fill a particular seat. So it does often depend on the size of investment, the percentage of investment, the sector, as well as who else is on the team from who made the deal happen to begin with.
Yeah, and maybe one of the other panelists can talk a little bit about their experience, but in some cases, these are full-time roles, in some cases are not full-time roles. How do the other folks in the panel see that?
I'll comment. There's a wide range of opportunities actually in private equity for board members, and for people who have been in an operating role for their career. One opportunity is as an operating partner. In some cases, that is a full-time job. So that means you do not do other boards aside from the boards the private equity firm has for you. And it also includes your helping the private equity firm review, create, and drive theses around different parts of the market. So if it's a thesis around cybersecurity, or a thesis around networking, or a thesis on SaaS, or whatever the case may be, you will be both working with the team to help them fill out that theme and who's in that ecosphere and what opportunities might be available to the private equity firm to essentially work with those companies, or possibly take them private. So you do that, and in addition, you often sit on their boards, and in some cases, I've had this experience as well, where you are executive chair. And in that case, you actually use a pretty good portion of your time on that company alone. You sort of are the second to the CEO, and you dive very deeply into the company, and you have responsibility for that company's outcome. The board overall has a responsibility for the outcome, but you're more on a day-to-day basis as an operating partner. So there's a bunch of different models in private equity, and they range from, as I mentioned, operating partner or executive partner, which is what I've done, but also you could just sit on one of their boards as an independent board member. I do that as well. So it varies. There's a pretty good variation.
Do you find you enjoy one role over another role, or is it company specific, or is there any advice you have for the other NACD members who serve on boards about trying something different?
I'll comment, and then I know Mike has a lot of experience here too. So I'll just say that it really depends on what you want to do, honestly, because if you want to work full time with one private equity firm, that is a possibility. You can do that. Vista is a very good example. They have operating partners in their company that strictly focus on Vista equity portfolio companies, and they are very, very engaged with just those companies. At the same time, Vista has people like me who come in and were board members for a particular company, and we're independent board members in those cases. So it really depends on you in terms of how you want to fill out the portfolio that you have. So I made a choice. I started doing quite a bit in private equity. I had one public board, and then over time I transitioned more to having more public boards and a smaller responsibility in private equity. And that ended up being.
Totally agree with Bethany. I think it's your choice as to what you want to do, but there's also a component of what they want you to do, and are you willing to do it? And I think that's a big distinction as you consider the opportunity, getting to know the private equity company and how they operate. And you mentioned Vista. Vista's got a very, I'll say, rigid operating model, which there's no problem with if you can operate in that. Others are looking for the board members to kind of drive that operating model.
Right.
And on the boards I work on, I'm an independent non-executive director in each. The one I chair, I work really closely with operating partners I work with HG Capital on both of these boards, and I work pretty closely with them. So again, I think it's a choice. You have to understand what you want to commit to.
Yeah, well, one of the things interesting, Mike, is when you were a CEO of a public company, you had a relationship with board members that's different than the relationship that you're building now on private equity boards that you're serving on. I thought that was interesting. Maybe that's worth sharing a little bit too.
Sure. I would say both with RealPage, which was a publicly traded company, and Wolters Kluwer, a publicly traded company, I interfaced quite a bit with the boards and the investors, if you will, which were some of the larger institutional investors. I would say that the activity level of those board members with the operations team was relatively low. At a CEO level, there was a good connection point, if you will. They provided value without question, but very rarely did they ever get involved in anything operational or anything that was really, I'll say, day-to-day activity, or even counseling beyond the CEO. I would say a big distinction, and I see this with all the boards that I've worked on, is that, they expect me to take a more active role in the business. So at Caseware, where I chair the board, I was just on a call this morning for 4 hours. It's our monthly operations call. I had every executive leadership person there. And then I have one-on-ones with the CEO each week at a minimum, other board members periodically through the week, occasionally with the commercial, the development head, So I spend, I will say, a significant amount of my weekly time, which isn't a ton of time, but I spend it, really counseling people. I've also done a lot of work recruiting. So the head of technology at Caseware came from me. I've recruited a number of CEOs over the years. So I'd say it's much more active than the experiences I had with the public boards.
I would comment because I was also a public company CEO. Ixia was publicly traded. And what I would say is mine was a little bit unusual in that the chairman of the board was the founder of the company. And so he actually was quite active in the company in a funny way. He worked for me as a technology leader, and then I worked for him as the chair. That is very unusual. The other board members, as Mike said, really didn't engage much outside of the quarterly meetings that we held, with the exception of perhaps the audit chair who was involved with us, for various reasons across the quarter and different circumstances. But for the most part, board members in my company and in most public companies have a fairly hands-off approach, an arm's length approach in a certain sense, because they're independent. That's the difference. In the case of private equity, as Mike mentioned, you're very engaged, and like Mike in the private equity side, as a partner as an executive partner who was involved with their businesses, same thing. I did recruiting. I looked at go-to-market plans. I looked at product roadmaps. I spent time with operations. I talked to the CEO throughout the week for various reasons. It's a different requirement, and you have to be aware of that before you take on a private equity role. And also, when you move into the public market, you can't really behave that way because the company won't really like you to do that. And that's actually not your job. So,
Bethany, I don't know about you, but what I find by being that active, I understand the business much better.
yeah.
I mean, I'm intimate with the business without having to try that hard because I'm, so often talking about it. And it's something that I enjoy. I mean, it helps me, I think, do my job better.
Yeah.
Building on what you both shared, we often find ourselves in the situation where with certain companies, perhaps we have, a CFO or CMO who are new in seat in the company. And we find that ensuring we have a board director who brings in that strength and that expertise and can serve as a mentor is actually the best way for us to use one of our board seats. So I would kind of invite the NACD members on the board here, if you do have that kind of propensity for mentorship and you're speaking with any private equity firms, do let them know that because those opportunities are always on our desk, and we'd love to know about that.
Yeah, that's interesting, Mallory, because myself and Mike are former CEOs, right? But I know I have many friends who are in private equity who have had other executive roles in the company, like a CRO, a former CMO, a former CFO. And then they actually do a lot with private equity because they fill certain roles on the board that the company requires.
Yeah, so there's an interesting distinction there, which is that a private equity board has real opportunities to coach and counsel and offer strategic value that might not exist on a public company or differently constructed board. Alex, one of the things that comes up for us a lot is, is when we pick these board members, there's often a limited number of spots available for somebody from the outside on a private equity type board. And that puts a lot of pressure on those board members. Maybe you could talk a little bit about some of your experiences there.
Yeah, for sure, Steve. I mean, in my perspective, I tend to be advising the private equity fund or the controlling shareholder, right? So as you described and as Bethany was mentioning earlier, or Mallory, I'm sorry, generally on these controlled boards, most of the designees are going to be people on the deal team, right, who led the investment, and they're employees of the sponsor, right? But it is, fairly common, since the boards are still going to be controlled one way or another, to allocate, one or two seats, whether it's to an independent, to an industry expert, to somebody in more of a mentorship capacity. And, who that individual is obviously there's some strategic benefit to, do you need a mentor? Do you need somebody who kind of brings more industry expertise or can help scout, potential M&A opportunities? But also I find, there's also some value in bringing in somebody who, for lack of a better word, right, can kind of approve transactions that are affiliated, otherwise are, conflict transactions, where if you have an entirely controlled board, there's really no ability to cleanse certain transactions for the benefit of the minority. So, take a pretty common construct where you'd have a private equity controlled business, you have maybe, a 20% minority rollover stake, and the fund wants to do a dividend recap. And if you have a bifurcated preferred common structure, maybe it's the preferred, right, the sponsor, to the detriment of the common, right, which potentially could include folks who rolled in and got their equity subordinated, right? That's effectively it's a controlled transaction. It happens all the time. And there's really no way under state law to cleanse it if you have an entirely controlled board. So oftentimes that independent, right, may be there for, providing some industry expertise or in a mentoring role, but they're also playing a second role, right, which is sometimes they're sort of the committee of one, right, the single disinterested director that actually has to approve those transactions. And sometimes that's not what they signed up for, because that obviously increases their potential exposure to liability, which gets into a whole, another issue around making sure that the companies that you joined have adequate D&O insurance, right, to backstop any of your risk. But that's an issue I find kind of comes up frequently, right? Which is there's the role from an operational perspective, but legally, are you also stepping into something that maybe you didn't sign up for initially, but which the sponsor thinks that you have a real benefit in potentially playing?
Actually, that leads me to one of the questions that came through. Andrew Shapiro pointed out rightly that the law in Delaware is evolving on this idea of entire fairness and the number of independent directors. And often we're coaching clients on having more than one independent director, in part because no one person wants to take on all the risk. But one of the changes coming through in Delaware is really this requirement that you have 2 independent directors if you really want to have a cleansing board vote. Any thoughts on that, on those changes, and how you see that maybe affecting? I mean, it's pretty early still, but any thoughts on how that might affect how boards are constructed or how people are thinking about boards?
Yeah, look, it obviously puts more pressure not just on adding in another individual, right? But once you have 2, there's an opportunity to deliberate, and so there's much less kind of rubber stamping, right, than if you have 1. So I think it's likely to put more pressure on people who have the sort of substantial wherewithal to sort of see through a financial transaction with a level of independence and appreciating the risk that they personally are taking on if they're evaluating it for fairness. But to me, it also kind of harkens back to this kind of broader theme that in a public company, you have a substantial cross-section of the board is going to be independent. They're ultimately answering to shareholders. They're subject to annual elections, and so there is some ability to kind of come in and come out and not have it be a day-to-day job. Whereas irrespective of how long you're elected to the board of a controlled private equity-backed company, every day you serve at the pleasure of the sponsor. Right. And so every day you have to prove value, and every day you have to bring your worth. And sometimes that means, working a lot harder, right, than you might otherwise do on a public company board.
Mallory, any discussion at TPG around SB21 and how that's affecting how you're thinking about boards going forward? Or is it still?
As I saw the question come up, as the person who does all of the analytics across our boards, I was just checking for our control deals. And
nice.
well over a majority of our control deals, so really our capital fund, already have at least 2 independents. So I don't think we'll be too concerned about any new changes that would bring in, because that's already, it seems like, part of the normal plan when we go into those situations. I think the bigger question is going to be when it's not a control deal and you only really have 1 independent seat and multiple different investors at the table. How do you make that happen when it's kind of a consensus? I think that's probably going to be a bigger topic.
Yeah, and Alex, just to stick on the legal side for a second, there's a follow-up question, which I think on the legal side, which I think is an interesting one because it comes up a lot in the boards that I represent, which is if the independent director helped the deal team as an advisor or regularly works with a PE firm or is being compensated by that PE firm outside of that board role, how does that affect their independence, in transactions? I have some thoughts, but maybe you could share some of your thoughts.
Yeah, sure. So, independence is usually viewed in the context of the transaction, right? So remuneration from the sponsor is certainly relevant, right? And obviously any plaintiff's lawyer, I think, would hit back on the fact that, ultimately the independent director is being paid by somebody. But the lack of an interest in the transaction over which they're approving, right, legally is cleansing. But these are all very fact intensive inquiries, I think. And, I think you need to be able to cleanse these, notwithstanding the fact that an independent might have, some compensation through the company, right? There's always some level of interest. But, back to my kind of dividend recap transaction, right? If there's a transaction in which the holders of certain securities are going to benefit, right? The holder is the sponsor. The independent director doesn't hold those securities. He or she doesn't benefit from that transaction. And so I think under Delaware law, they're fairly safe from an interest perspective, right? But they may otherwise lack independence under a public company or exchange definition, right? Because there is a compensation connection to control the shareholder.
Could I comment? I'm not an attorney,
Yeah.
so just want to be crystal clear about that. But I would think so as an independent board member on a private equity board, normally the way compensation works for an independent board member is that it's very similar to a public market board where you're paid, a de minimis amount of cash, and then you also are paid in equity, just like any other director of a public company. You do not have you don't have carry. You haven't made an investment in the company. That's not you don't do any of that. So I can imagine, again, not being an attorney, that you would have as much independence in a situation like that where you're an independent board member on a private equity board as you would on a public board as well, I would think, as long as you don't have carry or you're not invested in the company in another way. So I would suspect that to a certain extent, your liability would be similar. But, again, back to the attorneys. That's my opinion.
I completely agree with that, with the one wrinkle that it's hard to draw the analogy to a public company scenario where it is a controlled public company, right? And so even though the compensation comes from the entity, you're still there because of the big shareholder, which is tough to replicate in that other fact pattern.
We did have this issue actually come up with the TPG board because we have three directors listed as independents who have all served on prior private equity or prior portfolio company boards of ours. And so we did have to run through this question in a unique situation to ensure that we had the independence we needed.
Yeah, and so I think the couple of distinctions to think about. One is there's independence for the context of, meeting the rules for public companies on a stock exchange. That's different than maybe the independence when it comes to making a decision. And when you're making a decision, I think you have to think about the facts and circumstances of that person's independence for that decision. So for instance, if you're being paid by the sponsor and the decision you're making could affect that sponsor, there may be some concern there around your independence. That's the nature of the question. So I think what you got to look at there is you got to look at what percentage of this person's compensation or net worth or what have you is part of that compensation. So for instance, in a lot of situations, we have board members who, maybe have some small stipend from a sponsor that is one very small aspect of their overall financial picture. And so in no way would they be trying to protect that by making a vote, and we can find a path to independence for them. Whereas there might be a different circumstance where that person's whole, job or compensation or their livelihood is tied to that sponsor, and therefore that lacks independence in that context of the sponsor. So I think that's also thought of when you're looking at adding somebody to a board. These are often things that we're looking at even before somebody is added to a board, because as Alex said, for a lot of sponsors, this person plays an important role down the line, potentially in managing those sort of preferred versus common discussions that come up.
You know, Steve, this goes back to something Mallory said at the very beginning is when you're getting attracted to private equity, oftentimes the first way that you get in is through an analysis of a company they're going to acquire because you may have some industry expertise. You might have something special to offer to them. And it's their way of getting introduced to you and understanding it. So I go back to maybe the premise of what we started here. Should we join a private equity board? And if so, what does it take? I think this might be one of the things you consider and worry less about the independent side of it. That's a legal issue, and that's for the PE company to worry about, but more of how do you enter a public or a private company board, and it might be through that activity.
That's true. Very often it is. In some cases it isn't. With Vista, that wasn't the case for me, but with Cirrus, it absolutely was. I got involved with Cirrus working on a particular theme that they were interested in. I spent a lot of hours helping them prepare for, you know, who they were looking to potentially take private and why, working with them on the whole thesis that they had developed, all of the financials, everything. And so I agree that Mike, it is the way you normally do start to engage a private equity firm. And then I again, back to my not being an attorney, I don't know what that means from an independence perspective overall, but it's a really good point in terms of how normally you end up engaging in these private equity firms.
And I'm going to wrap us up here on this first topic fairly shortly. There's a couple questions I want to address, and then we'll move forward. One thing, Mike, to go to your point, if you were paid to do some work and then got on the board and no longer are being paid, I think your independence is a bit better story than if you were being paid, you know, continuously to help them look at other opportunities, let's say. So one thing to think about there. A couple questions that came up on the board that are very practical, I think. One is there a listing of openings? How do you find out who's looking for board members other than the networking you're doing at the NACD? Anybody have a thought there?
I have never seen a listing for an opening from a private equity firm.
They move too
Yeah,
fast, would be
you
my.
network a lot.
Right.
That's
The
what
way
it's about.
it happened for me was I sold my company, and one of the folks who was interested in acquiring my company showed up on my doorstep and said, "Hey, you want to work?" After I sold it, and they weren't allowed in the process. Sorry. So, but they showed up and asked if they could work with me. You know, since I was thinking about what would I do next.
Right.
But I would think, but oftentimes it is through networking, and NACD is a great place to be for that because people like Mallory hang around NACD and Mintz as well, clearly. And so I think it's an excellent way to get to know folks who work in private equity who could help you if you're interested.
Yeah, I think that's right. All right, the other question that was came through is it common for board of directors to invest in the PE firm or a specific portfolio company? And do you think it's a requirement that you're invested in the PE firm or the portfolio company? Anybody have a comment there?
I would say it's not required. If you might get an opportunity to co-invest with them, and that's something you can or should consider. But it's not a requirement. I've never found it to be a requirement.
No, me neither. It really, sometimes you are offered that opportunity. I have taken that opportunity, not in Vista's case, but in another case, to co-invest. And I think I then became a non-independent director. But anyways, I did continue on the board working on behalf of the company. So I think it varies.
Yeah, I would say if you were going like a private placement, angel funded, you might have that ability to get on a board with your investment, maybe venture based, venture cap based, but I've never had it with private equity.
Yeah, and I would agree with that. I don't think it's necessary at all. I think better to be providing the kind of value you guys were talking about that you've provided, that strategic value or that unique skill that you have. It'd be better to use that to network probably into it, because as Mallory said earlier, that's often what they're looking for. They're like, wow, we could use somebody who has this expertise, AI or whatever it is, And it's more likely to pull that person in than they would pull in somebody who was somehow writing big checks, I would guess.
Yeah, I agree. I mean, there's plenty of LPs out there that are willing to fund a good private equity portfolio company. And honestly, the rest of the folks on the board are deal team people. So they are financially highly astute, and many of them have a lot of background in certain kinds of operations within the company. But many times they haven't served in a company per se. And so they're looking to you as having lived it to kind of, see around the corners and make sure that what's happening in the company, makes sense, and that you can bring your experience to bear. That is the value proposition that you bring to the private equity firm.
Yeah, and I think it's two-sided. Bethany, you and I talked about this last time we met. Was as the CEO, it's the loneliest
Yes.
role in the world, right? There's nobody to talk to. And sometimes understanding what private equity wants from a CEO leaves a CEO in a perplexed situation. They need somebody to talk to and help them navigate that. And
Yes.
vice versa, sometimes operationally, the investment team isn't the right team to make an operational decision. So you
Yeah.
have to be able to be an arbitrator and bridge the gap between that. And that's a role I know I play quite a bit, going back and forth. And it's, you got to, sometimes you just got to let a CEO know that I won't make judgment. Tell me what you need to talk about, your worst day, and I'll help you navigate through it.
Right. That happens quite often. A lot of issues around comp too, because you're competing in the public markets, and sometimes, private equity has never been, as an example, in the market that you're currently in, and they don't understand what it takes to retain people in that market, given what other opportunities they have. You can translate that for them. So there are things like that that really provide some value that,
It stops charging after half an hour. So I just unplugged it.
Thanks.
Half an hour.
If we
So
could have
that's why
that, we have that person mute themselves, please.
Anyway,
it was a nice opportunity for me to transition us to our next topic around crisis planning. Look, I spent a lot of time with boards, and one of the things I've noticed in the last 12 to 18 months is just how nervous boards are about what's coming around the corner. The occurrence of these like black swan events that never seem to happen seem to be happening with greater frequency. We had the pandemic, the Silicon Valley Bank failure, tariffs, I would suggest, is even like a black swan kind of event. And I think this year ahead looks a little bit volatile. The stock market's volatile. The interest rates are high. We might be heading towards some recessionary things. There's the tariff issues that are going back and forth. And I think there's a lot of board members who feel like that this is a time they can add value, but are a little lost about how to add that kind of value. And maybe throw it to you guys, Bethany, Mike. How are you adding value on your boards with these kinds of like black swan or these kinds of bigger crises that are happening in the boardrooms today?
Yeah. Well, there have been several pretty good black swan events recently with COVID. That was a huge event. Everything from people having to work from home or having the ability to even do that, work from home. But also there was the supply chain backlash issue that came up after as COVID ended, that I was on a private equity board that, had product problems with regard to getting anything, into factory and then getting it out of the country to ship to their customers. It was a pretty big black swan event. And this tariff issue too, another one where, I was in a board meeting this morning where we were going, okay, it could be this, or we had the Liberation Day, number, and then the sort of, well, yesterday the trade, courts basically stopped that, and then, but tomorrow that might change, right? So those are things that definitely we all as board members participate in, trying to help folks and guide them through how to survive these things and hopefully, thrive. And it's complex. I'm sure everyone on this call has been a part of these kinds of discussions, whether you're public or private. It really, is a tough time for both the company and the board in navigating their way through. But what you can do as a board member, I mean, like Mike, I was 40 years too in the market. And, saw a lot of interesting things happen and, had a lot of issues that occurred that I never thought would happen. And so you can bring these analogies to them to help them with, okay, this is one way to think about it, or this is one way to go, or let's step back a minute and take a look at the bigger picture and, reflect on that first before sort of jumping in and making a decision. So, and the other thing you have is you have this portfolio of companies. So you can see what other folks are doing and you can help your company with some of the experiences that your other companies are having. So that's all very helpful.
Yeah, I'd align with that. I think the first activity anybody does when they see crisis is they pull back. Everybody kind of stops, and which is natural. I think it's a smart move. You don't jump in the fire. You kind of figure it out first.
Yeah.
And I go back to just a couple of years ago as interest rates were climbing, inflation was high, interest rates were climbing. I can tell you, we took a look at it from a couple different angles. One, we looked at, our cost of capital and what was happening with that. We looked at our cash flow and our working capital to see what we had. We were more EBITDA focused, if you will. One of the opportunities we saw come out of it, though, is a lot of the venture companies pulled back quite a bit and they levered their investments. And this is anecdotal, but we hear in the range of instead of investing in 100% of their companies, they narrowed it down to the top 15%, and then they kind of squeezed the rest of them. What that meant for us is there were opportunities to acquire. And, if we had sufficient cash to do that, we could do it. Every private equity company, backed companies got some amount of debt on top of it. So you're watching that, but I think there's some opportunities that come up in these crises. So I would look to that. On the tariff issues, what we're doing right now, we've hired Deloitte to look at all of the tariff issues across all of our portfolios to see what impacts us. We're a technology company. Actually, both of my companies are technology companies, so I'm not sure how the tariffs will impact us. But I'm a Canadian-based company in one aspect and a UK-based company in another aspect. And so I don't know if that has an impact to how we sell software in the US.
Right.
So we have the pros kind of looking at it for us to make sure that we don't get swept up in this and have to absorb costs we don't have to have. I think another thing too, as the inflation was going up, this is going to sound a little like a capitalist, but as inflation was going up, it was, in the double digits in like the Netherlands, we were raising our prices by double digits and taking advantage of that. And so again, I think that's where the board comes in to say, let's put a practical idea behind this. The operations teams were always hesitant to raise price, but when prices were going up so high, you couldn't stand on the sidelines and not take advantage of that.
Right. I did something very similar with one of the companies that we had. We just had, a lot of our supply chain, the prices just went up like crazy, and then trying to find product, in distribution, it costs money to get that stuff in your supply chain and then bring it into product. And so we made a decision to raise price too. And people in the company were very concerned because, it's a knife fight out there from a price perspective in terms of product and selling. But, what we found was, well, that was just the way it was in the market. So we raised our prices and people still bought because they needed the product.
They still bought, they still renewed, and they still
Yeah.
used the product. So,
Yeah.
and satisfaction levels didn't change.
That's right.
Since the pandemic, we've had a regular meeting cross-functionally at the law firm to help boards prepare like crisis planning. So it's like a crisis planning group, and it pulls from corporate lawyers like Alex and me, but also from our securities litigators and even our PR folks that work for our government relations firm, come to those meetings and help us share information about what they're seeing, what boards are preparing. So we spent a lot of time doing that. And Alex, maybe it's a good time for you just to share sort of insights on how you not just responding to a crisis, which, obviously takes a certain skill, but even how you prepare for these crises when we don't even know what's coming around the corner.
Sure. I mean, fortunately, I think most of our clients and most of our private equity fund clients are, as ahead of the curve on this, I think, as we are. So we're usually brought into the conversation, not, hey, what do I do? But hey, we want to make sure that you're integrated into our larger plans. So that's, first of all, that's fantastic. We're rarely, reacting. And I would say that's true even, with all but the most, I would say, earliest stage startups. What can you do? You can review policies and procedures, right? First of all, make sure you have them, make sure they're up to date, and make sure that folks know how to implement them. And I don't just mean, regular business risks like we have to shut down a plant, we have to replace a CEO, but things that are really relevant every day now. I think as Mike and Bethany were talking about on one of our planning calls, I mean, every technology company, every company that's not a technology company, if they haven't had a cybersecurity event, they will soon, or they have and they just don't know about it, right? And so there's things that we can do in terms of advanced planning and counseling to help get ahead of the curve. But I don't think there's any substitute really for, being prepared, having a plan, and knowing what to do when the crisis occurs, not if it occurs.
You know what I think is unique about private equity companies that I really like is, as a portfolio company, you do have resources in the private equity firm. They actually have built a bunch of different expertise and sort of an operating group that can help you in different circumstances, whether it's a cybersecurity attack, whether it's, a supply chain issue, whether it's a change of management, whatever it is. They have groups within the private equity firm that have studied these issues, and they spend all their time trying to make the companies that they own better around these different areas. And that is not something you necessarily have in the public market. I mean, you go hire McKinsey or whoever, right? But you don't have a stable of people who really have various expertise that you can draw on. And I really like that about private equity. I think it's a wonderful thing that they do, and they do it for across the portfolio companies. And then they gather knowledge from, all of these portfolio companies, and they communicate with each other, right? The CEOs get together and talk about the issues they have and what they're dealing with and how to make things better. And the board members do the same thing. And then they have these operating groups. So it's actually it's a wonderful set of resources to have that you don't find in the public market in the way that it is there in the private equity world.
Thank you,
Yeah,
Bethany,
I saw some questions on the chat about venture boards being slightly different too, and we're not going to address a lot of venture board things, but that's a place where I think venture boards it's really challenging because you don't have as organized resources as you do in the private equity sector, and you also made that distinction to public boards.
I'd qualify that too, that the size of the fund or the size of the private equity company matters too. If you're
That's
TPG,
true.
you've got a lot of money and you've got a lot of investment in there. HG is very similar. But if you go to a single entity fund, you may not have those same resources. So as you're looking at, if you're considering a board, and it's a $300 million fund, it's not a big fund,
Yeah,
and they probably
that's a
don't have
great
those
distinction too,
resources.
Mike.
But
Mallory, do you want to jump in too there?
Yes, I was thanking Bethany for highlighting the unsung heroes, which is the operations group, which I'm formerly a part of at TPG. But it is true, kind of behind the scenes, we have this 60-person operations group, field ops, and they're kind of like a SWAT team where when we are in the diligence phases, they're a part of the conversation. They're helping to write the value creation plan, and then they are mobilizing their own teams who are all fully part of TPG to on day one be in there doing whatever it is that they think that they can do to get the research done, get the conclusions drawn, and then start moving things forward. Oftentimes they're also serving as interim C-suite executives to do some of this when a search is ongoing or they know they need to do one in those examples. And those people also love partnering with senior advisors who bring significant industry experience in that space, who are also then often slated for the board to help that particular company to do what it needs to do for TPG.
That's great. I'm going to move us to our next and last topic, which is, there's a lot of focus here on risk, and that's a big aspect of your board service. But as Winston Churchill said, there's never let a good crisis go to waste. So I want to delve into a little bit before we get off our Zoom here. What are the unique opportunities we're seeing in today's market? And actually, I'll ask Mike to tell a story about COVID and the opportunity when you were selling a business and how you thought maybe COVID was going to be a negative, but it became a positive. I think that's a good story to kick us
Yeah,
off.
so I would say going back to 2019, I was part owner of a company called XEM Solutions. We were a workflow company in the accounting industry. So we were kind of like the manufacturing level, if you will, of every process that went through an accounting firm. And we were going to market in 2019, late December. We decided to go to market, and we started we got our bankers, started the process, and obviously March, COVID hit. So we were all prepared, all the paperwork, we were ready to, we had already done some pre-work with a couple private equity companies that we were looking at. And March hit, everything stopped, everything paused for a second. And so as a board, we sat down and talked about it. And the consensus was, let's just pull back and hold off. We got to run our business. Let's take care of our employees. Let's take care of our customers, and let's figure out what's going to happen here. What we found, which was interesting for us, is that as everybody went home to work and they couldn't work, our product became exponentially valuable because they used it everywhere. It's how we distributed work within the organization. It's a cloud-based app. And so by the time we got to June, we were in the, one of the big things we did was income tax. Typically our usage after April 15th, the filing deadline, went to, almost zero. What we noticed is it barely dropped after April 15th. And they used it for audits and accounting work that they did. And so what we saw from June and July really brought us back to a discussion point that said, well, wait a minute, this COVID, while it's a crisis, it's a challenge, our product and usage is more valuable. Why don't we go back to market? And we actually took it to market in July, and we sold that company in September for a great premium. And so what we learned from that is, again, you can't just stop. As a board, you can't be shy. You got to be a little bit aggressive and maybe be willing to take some risks sometimes. In this case, it was the right move to make. And like I said, it was a point where it could have been impending disaster, and it turned out to be actually fantastic for us.
Yeah, that's a great story of like the business being more valuable in a crisis. And sometimes it's not intuitive, and you have to think through the problem to get to the real solution. Bethany, what other opportunities are you seeing in today's market that are different than
well, I actually had a similar story because I was executive chair of a VPN company actually that was moving to SASE, which is the new standard in access and in network access and primarily security. And same thing happened. We were going to go to market. We were in late 2019. The company we felt that we had the right valuation in terms of what we were expecting for the sale. The COVID hit, and then we sat around for a couple of weeks going, oh, what could happen? What could happen? And then we realized that it went crazy actually, because everybody needed capability to get into their all their IT systems remotely. So in using a VPN. So it was a huge opportunity for us to, we sold the company with a great premium in the late part of 2020. And so it worked out very well. But if you think about now and what's happening, with the tariff situation and the uncertainty, I think some of the things that folks, might consider are, if they're in the software space, I guess the good news from that perspective is there are no tariffs in that so far, thank God, that we've seen. And what we found in Box as an example, which is a public company, just had our earnings. We did really well first Q. And there's some places in the market where it's not necessarily, doom and gloom, which is really good. And where you can offer value, especially around AI in particular, or in cybersecurity, now versus like a couple of years ago. So there's some good places in the market. I know TPG has a lot of software companies. I know Mike's on software company boards as well. these are spaces where the market's continuing to be pretty strong and to be a good opportunity, for the portfolio companies of that private equity firm. So something to think about. Where are the pockets of opportunity in this tough market? I'll give you another example. Lam is a big semiconductor manufacturing equipment company, but they sell product to Asia. They build product in Asia, right? So there's a lot of goodness to that it doesn't have to come into the United States, that it doesn't have to go back and forth between the United States borders. That's very positive as well. So looking for things like that, I think you can find some good pockets of opportunity.
Yeah, I spend, maybe I'll kick it to Alex here in a second, but I spend a lot of my time in the M&A markets, and I think there's really great opportunity right now. There's companies that need to raise cash and want to sell off pieces that are not part of the core. There are opportunities to pick up some real value in that because a lot of the really good companies that are independent have been picked over pretty well in this market. So I think there's a lot of good opportunities in the M&A space, and it might be an opportunity to really find growth through M&A in an environment like this. But Alex, what are your thoughts around where the opportunities are you're seeing?
Certainly hit on a couple of them. I mean, we're actually working on one public company carve out right now. I think it's just a classic case of shedding non-core assets, which you seem to see a lot more of when stock prices are a little volatile. Stocks are a little bit all over the map, but certainly for companies that are a little bit cheap, increased buying opportunities. There's a lot of things that I think are priced very cheap in Canada now. It's not just a shout out to Mintz's Canada office, but we're certainly seeing a lot of, I think, M&A activity coming in from the U.S. over the border, notwithstanding the tariff situation. Tariffs, I think, are also driving a lot more increased focus on supply chains. And so, acquisitions that present opportunities for, particularly hardware companies to diversify supply chains, we're starting to see some interest in. And then taking a step back, I mean, on this larger theme of just a lot of private companies that VC and private equity have backed and have not been able to exit at values that they expected during the later parts of the pandemic. We're starting to see really an increase in secondary activity. Blackstone announced a $5 billion secondary, I think 2 days ago, buying a variety of GP stakes in private equity from the New York State pension system. That's kind of a macro example, but we've also started to see over the last year or so, funds that are trying to capitalize on the opportunity of, founders or early stage investors that are, long in the tooth and maybe have some equity, but there's no opportunity to monetize. So that's driving a lot of secondary activity in the marketplace.
That's great. And we're going to be wrapping up here pretty soon. Before I jump off of you, there was a question earlier that I thought was really good around, are there different duties for sponsor directors than independent directors? And maybe you can address that question really quickly.
Yeah, great question. I mean, at a high level, no, all directors of Delaware corporations owe their duties to shareholders, which can obviously get complicated when you're designated by a shareholder or a contingency of shareholders, particularly one with liquidation preference that may put you at odds with the common stock, or, occasionally, but more rarely, seeing lenders designating people on the boards, which is always a little precarious, but creates, obvious conflicts between, different positions in the cap stack. So, that's how I think about that generally, Steve.
That's great. Thank you. And we're going to end on time today. I know there was a couple questions we didn't get to address in the chat. Please reach out to any of us to help answer any of the questions that weren't answered. Thank you to the NACD community for joining us today. Thank you to the panelists who spent their time preparing and showing up today and sharing their expertise. I think the answer is no need to send condolences to your PE board friends after today, and maybe instead send them a high five. And there's lots of opportunities out there, even in challenging markets, and it's clear that the strong boards make a real difference. And so as a board member, stay curious, stay engaged, and thanks again for participating in a panel like this and staying engaged with the NACD community.